The Federal Reserve just made 3 announcements, and I'm going to tell you right now that most people watching this video are going to hear what I say, nod their heads, go back to their couch, and do absolutely nothing. And those people are going to get financially destroyed in the next 18 months. What happened at the Fed this week is not background noise. It is not something you file away and forget about. It is a 5-alarm financial warning that directly threatens your paycheck, your savings, your mortgage rate, and your ability to build any kind of wealth in this country. I have spent decades studying markets, studying companies, studying the cold, hard numbers that separate people who build wealth from people who wonder where their money went. And I am telling you with complete certainty what the Fed just did. And what is coming on May 15th is one of the most consequential financial moments of the last 20 years. Pay attention or pay the price. If you're not subscribed to this channel yet, I need you to stop what you are doing and hit that subscribe button right now. The information I break down on this channel, the kind of clear, no-nonsense financial analysis that used to cost people thousands of dollars in advisory fees, I give to you here, completely free, every single week. The only currency I ask in return is your attention and your commitment to actually act on what you learn. Subscribe now and turn on notifications, because what is coming in the next several months is going to move fast, and you cannot afford to miss it. Let me lay out exactly what happened, because the financial media covered this story like it was a weather report when it was actually a tornado warning. The Federal Reserve Bank made 3 major announcements this week, and every single one of them matters to you personally. The first announcement was that the Fed is not cutting interest rates, and they are not raising interest rates either. They are holding them exactly where they are. Now, before you shrug and say, well, nothing changed, I want you to understand why that decision is actually a bombshell. The reason the Fed held steady is not confidence. It is confusing. The Federal Reserve Bank, the most powerful financial institution on the planet, the body that controls the cost of borrowing money for the entire United States economy, openly admitted that they do not know where the economy is going. Think about what that means. The people in charge of steering the ship just told you they cannot see the water. That should terrify you far more than a rate hike or a rate cut would. The second announcement is where things get even more alarming, because what the Fed revealed is that this decision to hold rates steady was the most divisive internal vote the Federal Reserve has seen in decades. We are not talking about a minor disagreement among economists. We are talking about a fundamental split at the highest level of American financial power. You now have Fed members on one side of the room standing up and saying, we need to raise interest rates immediately to protect the value of the dollar. And you have Fed members on the other side of that same room saying, no, we need to cut interest rates right now to prevent the economy from collapsing. Those two positions are not a small difference of opinion. They are diametrically opposed strategies with completely opposite consequences for your money. When the people running the Federal Reserve cannot agree on whether the patient needs more oxygen or less, you as an investor need to be paying very close attention, because that internal war is going to have a winner, and that winner's decision is going to ripple through every financial product you own. The third announcement is the one that the mainstream financial press almost completely buried, and it may be the most important of the 3. Jerome Powell, the current chairman of the Federal Reserve, announced that he is stepping down as chairman when his term expires on May 15th. We already knew that was coming. What we did not know, what nobody saw coming, is what Powell said. Next, he announced that he is not leaving the Federal Reserve Board entirely. He made a very specific, very deliberate statement, and I want you to pay close attention to the exact words, because words from a Fed chairman carry enormous weight. Powell said he will not leave the board until the Department of Justice investigation is, quote, well and truly over with, transparency and finality. Now let that sink in for a moment. The outgoing chairman of the Federal Reserve is telling you in plain language that he is staying on the board because there is an active Department of Justice investigation hanging over that institution. He is planting his flag. He is saying he is not walking away until that investigation reaches a conclusion. Why does that matter to your money? Because Powell staying on the board means his vote stays on the board. President Trump has been loudly and publicly demanding lower interest rates. The reason Trump nominated Kevin Warsh to take over as chairman was specifically to bring in someone who would be more favorable to rate cuts, but with Powell still holding a seat and still casting votes, Trump's plan to flip the balance of the Fed in favor of lower rates just became significantly more complicated. The chessboard just changed, and most people watching the news did not even notice. Now I want to talk to you about something called the net interest trigger, because this is the second major problem lurking underneath everything the Fed is dealing with. And it is the kind of slow-moving catastrophe that destroys economies quietly before most people realize what is happening. Here are the numbers, and I want you to sit with these numbers because they are staggering. The United States government currently carries more than $39 trillion in national debt. $39 trillion. That is money the government has already spent that it did not have. That money was borrowed. It was borrowed from individual investors, from foreign countries like Japan, China, and the United Kingdom, and it was borrowed from the Federal Reserve Bank itself. Now here's where the numbers start hitting you directly in the wallet. The United States government is currently paying more than $1 trillion per year just in interest on that debt, not paying down the principal, not reducing the $39 trillion balance. Just the interest payments alone cost over $1 trillion every single year. And where does the government get that money? There's only one answer: tax dollars. Your tax dollars, my tax dollars. The numbers work out to approximately 20 cents of every single dollar you pay in taxes going directly to interest payments on the national debt. You work, you earn. The government takes a portion, and then 20% of what the government takes goes straight into the pocket of the people and institutions who hold United States debt. That is the reality of where your tax money goes right now, and here is why this creates a crisis for the Federal Reserve specifically. For decades, the Federal Reserve's job has had two main focuses: keep inflation under control and keep employment strong. And that has been the dual mandate. But now there is a third pressure that is growing so large it can no longer be ignored, and that is the cost of servicing this national debt. Because if interest rates stay high or go higher, that interest payment does not stay at $1 trillion per year. It grows. Every time the government has to refinance its debt at higher interest rates, the annual interest bill goes up. More of your taxes disappear into interest payments. And the Federal Reserve now has to ask itself a question it was never designed to answer. Do we manage inflation and employment, or do we manage the survival of the dollar and the sustainability of this interest burden? That question has no clean answer. Every option comes with consequences. But what you need to understand as an investor and as someone who earns a paycheck is that this net interest problem is now sitting at the table whenever the Fed makes a decision about rates, and is going to influence every major financial policy move for the foreseeable future. The people who understand this will position themselves accordingly. The people who do not understand it will wake up one day and wonder why their savings are worth less than they used to be. Let us talk about Kevin Warsh, the man who is set to take over as Federal Reserve Chairman on May 15th, because his vision for the Fed is unlike anything we have seen in recent memory. And it is going to have consequences, good and bad, that will touch virtually every aspect of your financial life. Warsh has been explicit about two major things he wants to do. The first is to cut interest rates. The argument for cutting rates is straightforward, and it is one that many people find appealing on the surface. Lower interest rates mean cheaper mortgages. They mean cheaper car loans. They mean it costs less for businesses to borrow. Money to grow, to hire, to expand. More money flows into the economy, more economic activity happens, and in theory, the economy strengthens. So if you have been struggling with a high mortgage rate, or you have been watching housing prices stay stubbornly elevated because potential sellers are locked into low-rate mortgages they cannot afford to give up, the idea of rates coming down sounds like relief, and it might be for a moment. But here's the cold hard truth about cutting rates in the current environment, and this is where most financial commentators go soft, because they do not want to scare people. If mortgage rates drop to 4% tomorrow, what do you think happens to the housing market? Every person who has been sitting on the sidelines waiting to buy a house rushes in at the same time. Demand explodes, inventory cannot keep up, bidding wars break out across every major market in the country, and prices go up. That is not a theory. That is basic supply and demand. And it has happened every single time rates have fallen in a tight housing market. Now you have cheaper borrowing, which sounds good, but you also have higher prices on the things you want to buy, which eliminates the benefit and then some. That is how cutting interest rates in an already inflated environment makes inflation worse, not better. And inflation is already running above where the Fed wants it to be. That is not a matter of opinion. The Fed has stated publicly that inflation is higher than their target. Add to that the impact of higher oil prices driven by ongoing conflict in the Middle East, which makes gas more expensive, diesel more expensive, shipping more expensive, groceries more expensive, and fertilizer more expensive, and you have an inflation problem that is already getting worse before you even touch the interest rate dial. So how does Warsh plan to cut rates without pouring gasoline on the inflation fire? This is where his second major initiative comes in, and this is the part of his plan that carries the most risk and the most uncertainty. Warsh wants to shrink the Federal Reserve's balance sheet. In plain terms, that means the Fed would start selling off the trillions of dollars in government bonds and other financial assets it has accumulated over years of monetary policy, particularly since the pandemic. The logic is that by pulling money out of the financial system through these asset sales, You offset the inflationary effect of cutting rates, you stimulate with one hand and tighten with the other, and theoretically they cancel each other out. On a whiteboard, in a classroom, with a piece of chalk. That sounds reasonable. In the real world, it has never been done at this scale, under these conditions, with this level of existing debt. At this level of geopolitical instability, Wirsch has said publicly that he believes private demand will absorb the treasuries the Fed sells off, meaning other investors, institutions, and foreign governments will step in and buy what the Fed stops buying. He may be right, but if he is wrong, the consequences cascade very quickly. If there are not enough buyers for United States treasuries, the government has to offer higher interest rates to attract buyers. And when treasury rates go up, every interest rate in the country goes up with them. Mortgages, car loans, credit cards, business loans, because every financial product in the world is priced relative to what the United States government pays on its debt. That is the gamble on the table, and you are one of the chips. I want to make sure you understand with absolute clarity the trap that the Federal Reserve is currently caught in. Because it is not a problem with a comfortable solution. It is a genuine dilemma where every available move has serious costs, and the people running the institution know it. So on one side, you have pressure to cut interest rates, cut rates, and you stimulate the economy. Businesses borrow more and grow. People buy homes and cars. Employment strengthens, but cutting rates also risks making inflation significantly worse, particularly in an environment where inflation is already running hot and oil prices are already elevated. That inflation does not hit everyone equally. It hits hardest on the people who earn wages and save in dollars, meaning most working Americans. When inflation rises faster than your paycheck, you get poorer. Not on paper. In reality, the gallon of milk costs more, the tank of gas costs more, the rent costs more, and your paycheck does not grow fast enough to keep up. On the other side, you have pressure to raise interest rates, and you squeeze inflation. You make borrowing expensive, which reduces the amount of money flowing through the economy, which slows price increases. That is exactly what the Fed did from 2022 onward in response to the post-pandemic inflation surge. And it did bring inflation down from its peak, but raising rates also slows the economy. It makes mortgages more expensive, which freezes the housing market. It makes business loans more expensive, which slows hiring and investment. It increases the cost of carrying that $39 trillion in national debt, which means more of your tax money disappears into interest payments. And it puts downward pressure on stock valuations, which matters enormously to anyone who has retirement savings in the market. There is also a third pressure point that is not getting enough attention, and that is the job market. We are already seeing softness in employment in certain sectors, driven partly by companies choosing to automate with artificial intelligence rather than hire humans, and partly by businesses simply pausing hiring because they do not know what the economy is going to do. So when companies are uncertain, they do not invest. They do not hire. They sit on cash and wait. And when enough companies do that at the same time, the waiting itself becomes the problem, because reduced hiring leads to reduced spending, which leads to reduced revenue for other businesses, which leads to more uncertainty and more waiting. And that cycle, if it gains enough momentum, is what tipped every major recession in living memory. The Fed knows this. That is why the boat was so divided. There is no clean answer. There is only a series of imperfect choices, each with significant risks, and those risks belong to you. Let me bring this home in the most direct way I know how, because everything I've described so far is not abstract economic theory. It is a direct threat to your financial position, and I want you to understand exactly how and where it hits you. Start with your paycheck. The value of a dollar is not fixed. It changes based on how much inflation is running through the economy. When the Federal Reserve prints money, which it does when it lends money to the government, and when more dollars chase the same amount of goods and services, the purchasing power of each dollar falls. What that means in practical terms is that your paycheck in 2026 buys less than your paycheck in 2020. Even if the number on the check is the same or even slightly higher, the official reported inflation rate since the pandemic is around 22%. But the real inflation that most Americans feel, measured by what they actually spend money on, meaning housing, groceries, insurance, cars, transportation, and utilities, is significantly higher than 22% for most households. Your cost of living has almost certainly grown faster than your income. That gap is where your wealth is disappearing. Now look at your savings. Every dollar you have sitting in a savings account or a checking account earning below the rate of inflation is a dollar that is slowly losing value. You are not growing your savings by keeping cash idle. You are watching it erode. This is not a new concept, but the speed at which it is happening right now is new, and it is accelerating. Now look at your mortgage or your rent. If rates come down as Wirsch wants, housing prices will go up as more buyers enter the market. If you are already in a home at a fixed rate, that might not affect you immediately. But if you are trying to buy, a lower rate may not help you as much as you think if prices rise to compensate. If rates go up, your existing adjustable rate products become more expensive, and buying property becomes even harder. The housing market is essentially frozen in a no-win scenario until something breaks in one direction or the other. Now look at your portfolio. The stock market is highly sensitive to interest rate expectations. When rates fall, stocks generally rise because money is cheap and corporate earnings forecasts improve. When rates rise, stocks generally fall for the opposite reason, but we are in an environment where the uncertainty itself is creating volatility. And volatility is the enemy of the average investor who does not have a strategy built to handle it. The people who are going to come out of this period ahead are the ones who understand what is happening, who have positioned their assets intelligently across different types of investments, and who do not panic when the market moves against them. The people who are going to get hurt are the ones who are passive, who are complacent, who assume that what worked in the last 10 years will work in the next 10 years. Here's what I need from you right now. And I mean right now. Not after dinner, not on the weekend. Right now. I need you to treat what is happening at the Federal Reserve not as news you consumed and filed away, but as a financial event that requires a response from you. You have just learned that the most powerful financial body in the United States is internally divided, that its outgoing chairman is staying on the board because of a Department of Justice investigation, that a new chairman with a high-risk strategy is taking over on May 15th, that $39 trillion in debt is consuming 20 cents of every tax dollar you pay, and that every decision the Fed makes from this point forward will directly affect your mortgage, your savings, your paycheck, and your retirement. The people who hear all of that and do nothing are the ones who will sit down 5 years from now and wonder what happened to their financial future. I have spent my career watching people ignore the signals and pay for it. I have also watched ordinary people with no special advantages take the time to understand what is actually happening in the economy, position themselves accordingly, and build genuine, lasting wealth. The difference between those two groups is not intelligence, it is not luck, and it is not who you know. It is whether you decided to act when the information was in front of you. The information is in front of you right now. Share this video with someone who needs to hear it. Subscribe if you have not already, and then go figure out what changes you need to make to your financial position before May 15th arrives, because on that date, the Federal Reserve changes hands, and the next chapter of this economic story begins whether you are ready or not.